I do want to start there, Jay, with the direction of yields and the expectations that a lot of folks have that maybe that big spike that we saw earlier isn't over.
Yeah, Romaine, I think from our perspective, we are certainly over the medium term a bit more bullish on treasuries. We think the Fed's got one more hike to go at the May meeting, and then we think the Fed will be on hold until the second quarter of next year. We also think, as you talked about, that recession risk is rising. Jobless claims are at their highest level in about a year and a half, and any move towards 250K would be a more imminent sort of recession risk. Not to mention that we're at the early stages of a big debt ceiling debate as well, which what we found in the past is that when debt ceiling debates get very late in the game, closer to the X date, that ends up perversely seeing a pretty large rally in Treasury. So we think there's a lot of factors that point to lower yields over the medium term as well.
When we talk about the pressure out there, a lot of focus right now, of course, is on the Fed and the macro conditions here. The idea that the Fed does have the optionality to pause, and if you believe the pricing in the options markets, maybe even start to cut rates sometime this year. Are you in that camp?
So, again, we think the Fed's got one more hike to go next week at the May meeting. And then we think the Fed will actually be on hold until probably this time next year. And the reason being, we do see growth slowing and moving into contractionary territory. Ultimately, we see the unemployment rate moving up towards 5% as well. But the part of the stickiness here is that inflation, while it's coming down, is probably not going to be back at the Fed's target until maybe this time next year. So for us, we don't see an imminent recession. We do see slower growth, but inflation's going to be an issue. And compared with other tightening cycles, when the Fed has been quick to pivot, that's going to make it a bit more challenging right now, why we see them hold into next spring.
Are you comfortable extending duration at all over this shorter term cycle?
So we've talked about medium term being sort of a bit more bullish on treasuries and on duration here. But very near term, I think there's two things that make us a bit more cautious. The first is the Fed pricing that you talked about, and the fact that we're pricing in about 60 basis points of easing over the balance of this year. Second, we've got our own valuation framework for long-term treasuries, even adjusting for how the market's pricing Fed, inflation, and growth. And in that respect, it looks like 10-year yields right now are probably 25 to 30 basis points too low. So while that's our medium-term tilt, we'd prefer to wait for higher yields before adding duration, and we prefer kind of what we would call to be sort of low beta proxies for being long duration, like curve steepeners right now.